It's been a rough ride for investors in banking stocks since 2008 when the financial sector imploded. But signs are emerging that some banks deserve a closer look in 2012, despite the lingering housing mess and low interest rates that make it harder to profit from loans. First up, national banks. Don't expect blockbuster growth in big banks' bottom lines. The next decade is shaping up to feature muted earnings gains and modest share price appreciation. For now, avoid the three largest banks in the U.S., Citigroup, JP Morgan, and Bank of America. All are weighted down by a host of problems, from exposure to the European debt crisis to foreclosure scandals and lackluster trading operations. Of the remaining national banks, U.S. Bancorp and Wells Fargo are the most attractive. Neither faces significant risk from Europe, and neither is grappling with bad mortgages to the extent of the big three banks. Another plus? Both banks raised dividends last year and should do so again in 2012. On to regional banks. Regional banks are better positioned than national banks because most avoided the brunt of the mortgage crisis. As a result, lending is on the upswing. Regional banks can be pricey these days, but two that still offer attractive valuations are PNC Financial Services and Fifth Third Bancorp. If you want exposure to regional banks as a whole, consider an ETF. Either iShares Dow Jones U.S. Regional Banks Index or SPDR S&P Regional Banking. Last but far from least are community banks. With a focus on residential lending and savings accounts, community bankers tend to know their customers and their markets. Good bets include First Connecticut Bancorp, Oritani Financial, Bank of the Ozarks, and Webster Financial. You can also invest in community banks through the First Trust Nasdaq ABA Community Bank ETF. For Kiplinger's Personal Finance, I'm Jennifer Schonberger.